And one of us was then approached by an LP that said, hey, I've diligenced multiple funds that invest in construction tech, and I like none of them. But I like you. Would you like to found that firm? I mean, I met my wife 21 years online, 21 years ago. And so to this day, married, happy, etc.
I met my wife online as well.
So
I met my wife online as well.
you met your wife online, okay.
Yeah.
Outlier.
Most VCs raise funds because there is fundraising opportunity, not because there is what we call DPI opportunity, distributions to paid-in capital opportunity. The difference is, well, some people raise funds because they can raise it. And some people raise funds because they can return it exceptionally well.
Both are,
we love bricks.
and bricks as well. So
And bites.
And bites.
and
We also love bites.
Thanks for that.
Very good.
Thanks for that.
So today we have a very special treat, an inside look into one of the most innovative and forward-thinking venture capital firms founded by a group of unlikely partners who shared a vision and are betting big on the world of AECS tech. And most VCs play it safe, but Foundamental dares to be different. And today we sit down with Patrick and Shub to hear their story firsthand. So let's start from the beginning. Can you share a story of how Foundamental came to be?
Can we?
Unison.
Give it a try. Give it your
Okay.
best try.
So our origin story is indeed a little bit wonky, but I would say that is something that half of the VC firms out there will have a wonky story. There's no regular straight path to get into VC, and ours was similar, right? So for us, none of the three general partners, Shub, myself, Adam, came from construction. We didn't come from architecture, we didn't come from design. None of us actually had a background, but two of us were in prior VC partner roles at revered firms. One of us came from corporate, and one of us was then approached by an LP that said, hey, I've diligenced multiple funds that invest in construction tech, and I like none of them. But I like you. Would you like to found that firm? And it's, of course, at that point quite tempting to say yes, but we didn't. So for us, it was actually only the kickstart to really think about whether we would bet our careers and our lives onto that, into that sector. At the time, all of us were mid-30s. So it was, still a good time when you could make that bet. But in founding a VC firm, you're not making like a 3-year bet that you typically do when you switch a job. You're actually making a 10 to 12-year bet because you have to see the fund through. And in founding the business, of course, the commitment then is very, very high. So for us, we had to project forward and ask ourselves, okay, it's nice if you can get a first well-wisher and backer, but we have to be convinced that we can deliver cash and very high returns over the next 15 years plus. And so that led us to doing actually almost 9 or 10 months of diligence. And when we kicked that off, we had no idea this would lead us here. And after we did it, we felt like, yeah, we want to bet our careers on it.
Yeah. I mean, I remember in the early days when a lot of these, I guess, discovery discussions were happening, I even, reached out to a few people I respect in the ecosystem with this idea that, hey, there's this opportunity that may come along my way to sort of found a VC in construction tech, VC firm in construction tech. And a couple of them actually had the reaction, what is construction tech?
That doesn't exist.
Yeah. So, and that is one of those things where I think there were moments in my mind when you hear stuff like that, one part of your brain, there's two voices that came up off my shoulder. One said, oh my gosh, this is like terrifying. There's people actually saying, what is construction tech? And now we're talking about setting up a fund to do something that people don't even know what it is about. This seems like a terrible idea to stake our careers and our future on. The other part of my brain, and I'm very, very glad I listened to it, was the idea was like, hey, could this be like a cool story 10 years down the line where you actually create a new paradigm and even prove people wrong? And I guess I'm very glad that that's at least that's the voice I ended up listening to.
And I'm not sure we would have come to that same conclusion had we had backgrounds in construction, because if you're ingrained in an industry, it's so much harder to zoom out, right? And so for us, it was so easy because none of us came from it. This was late 17 and then like first 3 quarters of 18.
That's right.
I mean, construction tech, it wasn't a category. It wasn't even cool. There were a few early players in the industry. I wouldn't even call them generation one because there was just not so much funding around at the time that you really had to come to some kind of contrarian conclusion to bet your careers on this space. And not just us, I mean, anyone that at the time actually bet on construction.
And there's two aspects to what we're discussing. And I think it's important at this point to highlight the other important dimension to what Foundamental represents. One is, of course, that we are focused on construction and AEC as a sector, which by definition has very few firms in that sort of space. The other is we are also creating a truly unified global brand, doing everything simultaneously. I mean, the other thing, when you referenced late 17, early 18, if you could roll back time and check what construction tech looked like and what the VCs who were there, very, very small number, firstly, like an enormously concentrated representation in the US.
Yeah.
Well over 90%, right? Which is why I guess when I think of it, it's only natural that when I reached out to my well-wishers, they're like, what is construction tech? They've never even heard of this term before, right? Just to complete the picture, I guess what made it a bit audacious was trying to do two things, or trying to create these two models simultaneously and bring it together as the model of a new VC firm.
I just wanted to pick on you mentioned that this LP came to you guys and wanted you to explore this vertical. What did they see in you? Was it a character, or because there was not like construction related knowledge? Yeah?
It's a good question. I mean, we should ask them. I think I know the answer. I think they saw that we had a quite differentiated thinking, that we got results, we got things done, very structured, very methodical, entrepreneurial backgrounds. I mean, my family is all entrepreneurs, for example. And this person that backed us, that wrote us the first check, also is an LP in many other generic VC firms. So they knew exactly what like a successful GP, general partner, would look like. And I like to think they saw, among the successful ones that they had backed, they saw something similar, right? And the thing that we internally always say about VC and being a general partner is it's a tricky industry to be successful in for many reasons that you don't control. But even for the reasons that you control, which is your personality, it requires you to be not bad and quite good at a very wide variety of skills. And then it requires you to be in one or two crafts. You need to be really exceptional. And so I can't tell you like what that person thought one of us was exceptional in, but I'm very certain they thought that, we don't have really a weakness that matters. And I think that's really important if you pick a GP that you like to work with.
So how did you guys meet as a founding team?
Yeah, it was through friends online. I mean, we basically, once we saw this opportunity, we reached out to our network and that's how we got connected.
Crazy story, I mean, to put it mildly. I mean, something we often get asked is, hey, you're staking so much into such an important decision. Don't you think you should do it with people you've spent years and years knowing and trust? I think and by the way, there's no denying the validity of that approach. I think it shows in some way that the three of us were at a very interesting point in our respective careers. I mean, in my case, I think a combination of ambition and the thrill of the opportunity took over. Perhaps, there was something similar and a mix of other ingredients in your case. And I think it was a meeting of three individuals with very similar appetite for risk and similar mindsets, which we got to know over a period of months. And I think sometimes, that's how opportunity and serendipity looks like. You recognize someone who complements you and resonates with you based on their ability to take on a similar sort of risk.
And it's how a lot of founder stories really that we have backed, that we have enjoyed success with also start. Oftentimes they start through mutual friends, even like online dating in a way among founders it's a thing, right? And so it can lead to very successful companies. Shub, I don't know if we want to share this, but I'm going to give it a go ahead. And then, I mean, I met my wife 21 years online, 21 years ago. And so to this day, married, happy, etc.
I met my wife online as well.
So
I met my wife online as well.
you met your wife online, okay.
Yeah.
Yeah,
Outlier.
I met mine in high school.
exactly. But what does it tell us, right? So it tells us that if there's an element of curation in the process, that adds a ton of value. But even, which in our case it was, right? But even if there isn't, you just need to commit to a process to get to know each other at a level that gives you the conviction that you want to build a company for 20, 30 years with each other. And it all starts with that commitment to having such a process with each other. If you don't have that commitment, it doesn't matter. If you have known each other for 20 years or for 2 months, you will never get to the level of depth that is required to have that level of conviction. It all starts with commitment. And then it doesn't matter how it was triggered, whether it was triggered online or offline or through high school or through 20 years ago. It all starts with that commitment to getting to know each other.
I agree. How was the first days? How did you come up with a mission, vision of Fundamental?
To be honest, a great deal of iteration. I mean, in a way, what was both good and bad is that there did not exist, and I would argue even to this day outside of Fundamental, there does not exist a playbook for a truly global firm that is focused on this sector. So in some ways, we were sort of iterating on the fly. I think what helped us is we decided that the winning approach, at least in the beginning, will have more to do with best-in-class principles in VC than going very heavy on industry knowledge in construction. I mean, of course, the three of us weren't equipped to, by ourselves at least, apply construction knowledge. But the idea was you could apply best-in-class principles in VC, use it to create a new kind of VC firm. So what we would also do is, in our own way, and now I guess time to throw a bit of jargon here. So
Nice.
a lot of high-quality VCs, especially in, let's say, outside of the US, are known to have built very, very successful investing track records using what is called as pattern recognition. And I personally am a big fan of that approach of investing, where you learn from what's happened before, not necessarily copy it because that has its own perils, but learn from it, localize it, adapt it, and invest in something capturing similar patterns and trends. And I think, we sort of did that in trying to establish winning playbooks, patterns that we see in high quality VC firms, high quality VC professionals that we have liked and admired, went about it, that way.
And so, Martin, you are asking about the mission statement. So the mission statement for a VC that you put on a website and the mission statement that you really have as a general partner might be very different among many VC firms. For us, it's actually not that different. We're being quite upfront with it. So we think that as a VC firm, our job is to allocate capital efficiently. That's our job, and then to return that capital with a very high performance. And
2x.
No, definitely not. So definitely not. But I'm not going to give you a number, but 2x would be underwhelming. But and it's the founder's job to change the world, right? So I think you would actually be fooling yourself if, as a venture capital investor, your mission statement was, I'm going to change the world. I think you would be completely in over your head if that's what you thought. All you are is a capital allocator and an enabler. You're a well-wisher, a friend, a supporter, right? But we're not the ones changing the world. And that for us, I think, was clear from day one. However, another conviction, I think that the three of us shared day -1, was that most VCs raise funds because there is fundraising opportunity, not because there is what we call DPI opportunity, distributions to paid-in capital opportunity. The difference is, well, some people raise funds because they can raise it. And some people raise funds because they can return it exceptionally well. And we've always been in the latter camp. And so when you ask me about the mission statement, quite honestly, it all has to start with that, always as a VC firm, right? So all we can do is enable people to change the world, which I like to think we have a few of them in our partnerships, right? But then, because I'm measured by how efficiently I allocate capital, right, I need to drive DPI. And so for us, that was day one. If we don't believe we can deliver a very, very strong DPI, we shouldn't be starting it in the first place.
just to reference what you said,
2x. Not this one.
but I'll address what you just said. What I have observed, and I think this observation has been common, and it's a pretty common observation around the world, with a lot of sector-specific funds, especially one that is truly emerging as a sector as construction tech was 6 years ago, quite often the ambition is, hey, we'll be a high-performing construction tech fund, or we'll be a good construction tech fund. In our opinion, so firstly, that is diluting the scope of what your ambition is, because what is a good construction tech fund? Because construction tech funds in general didn't exist in any significant quantity back then. So our objective always from the beginning was, we don't dilute the scope of what we can achieve just because we happen to be a construction tech fund. We need to be a high-performing VC fund at a global scale, as in competing with the best of the best, the likes of Sequoia, Accel, and so on and so forth. Our performance has to be comparable to that. And we happen to be investing in construction tech and happen to be global. But at any point of time, a financial investor or anyone judging us, because let's face it, when we started, we were a startup ourselves. So why dilute the objectives and the ambition we set ourselves? So we also need to hold ourselves to KPIs that are worthy of a high-performing startup. And therefore, that's the kind of KPIs we set for ourselves.
It's almost if you're a startup, right? And after a few years in, you keep telling yourself, hey, I'm changing the world, I'm changing the world. And then I look at my P&L and I'm like, well, customers don't seem to think I'm changing the world. Nobody's buying it. It's the same principle applied to us, right? So in the end, if you deliver the financial performance, you can claim that you're achieving a mission. But if you don't do that, any mission you write on the website is meaningless.
Perhaps a good question to ask is also, when you look at venture funds investing in construction in the past, were there qualities that you didn't want to apply to your practice?
Go for it. I mean, there's lots of things to unpack there. So
go for it.
I mean, look, to start off, there's aspects where, for example, you go after deals and opportunities not because they are the ones where you'll make the most money, but either because that's the only opportunity available for you, or you aim low and that's what you can win, quote unquote win, or that's what will, quote unquote, get through our investment committee. Because so let's say hypothetically speaking, not that we do it that way, suppose I've figured out what Patrick and Adam, the kinds of opportunities they like. And instead of positioning myself as an allocator and a decision maker for investments, which is what my job is, I position myself more as a sales representative feeding opportunities that Patrick and Adam will sign off on, right? Keep in mind, the latter approach in the short term probably has a statistically higher likelihood that I'll get deals done, right? But that is an approach where I have arbitrarily changed my own KPI, not to financial objectives in the medium or longer term, but the objective has changed to that, hey, I have done this deal, and hey, there's this notch now on my board that, congratulations to myself, I've done a deal. But I mean, is that really like an objective where you judge us, where we judge ourselves? Should I do a deal just because I can win it, or just because I've managed to convince Patrick and Adam? And the deeper you go down that rabbit hole, that leads to dramatic consequences, which are very unhealthy for a firm. Because now if you start on this dynamic where I'm thinking about, I'm profiling what Patrick and Adam like and not what the market will eventually reward, can I then also influence what Patrick and Adam will like eventually? Yeah. You know what I mean? Yes. So at this point, I am removing myself from my true responsibility, and I'm kind of becoming more of a broker, if you will.
Yeah.
The competition between who can have the most companies on their LinkedIn profile.
As well. Mm-hmm.
Yeah.
Sounds like a good metric to track.
Oh my God. But I would say, Martin, to that question, actually, I've never thought about it that way. Just because, my conviction is for any kind of company, if you want to put the best product out in the marketplace, you're never talking to your competition. You're always talking to in the end, who is your business partners, right? And in our case, that is founders we work with, who are business partners to us, and they tell us the product that they want. And so that's something that I think we've learned a lot over the years about, like what should we be focusing on? What do we, not necessarily focus on? What should we stop doing? But looking left and right, how other people do it, I think is a fallacy. And it can lead you in very suboptimal places for mostly the reason that you never get to see the details of how they operate. You think you understand a competitor's strategy, but because you don't know the details of executing it, you're much more likely of badly executing a strategy that you think is in place. And then that just leads you to suboptimal outcomes. So I have a very firm conviction that whatever you do in terms of business strategy should come from the grounds up, from a first principles perspective of how you see and perceive the opportunity, and then basically what your business partners tell you they would like in terms of an offering. That's how we've so far approached it.
Let's go on to AECS tech. So architecture, engineer, construction, and supply chain.
That's right.
So why is this category so ripe for innovation and, dare I say it, disruption?
So Shub, let me get started. And so there's a macro view here, and I think there is a dynamics view here. So let me start you off with the market view. So when we went back to the origins, right? And so sometime during 2018, we did this analysis from the macro perspective, how capital gets allocated in certain technology sectors. And the pattern is always the same. When you look after prop tech or travel tech or mobility tech, fintech, logistics tech, other sectors, the time it takes from when a sector reached 5 billion of cumulated VC funding to 10 billion, it's always 2 to 4 years. From 10 billion to 50 billion, it's always 2 to 4 years, which means, there's accelerating growth. Always 6 to 8 years from 5 to 50. And when we started Foundamental in January 19, it was at 4.5 billion. So again, this is not a singular exercise that you do and you're like, okay, now I'm banging the table and now I'm betting my career on it. There was a lot of other hoops that we had to kind of use to convince ourselves. But in the end, it was a very important analysis for us that described the macro logic, why capital will likely get allocated to the sector. And that is a very important precondition. So that's the macro part. The dynamics part can be summarized in 3 or 4 statements. So first of all, the demand for construction is inflecting. Even though in 2022, 3 or 4, it might not seem like that for several players in the industry. If you zoom out, we're going to add 1 New York City to this planet every month until 2060. Because it's crazy, right?
Numbers are saying, yeah.
So the demand is exponentially growing on an irreversible mega shift, right? Unless a comet hits the Earth, like that's what's gonna happen. 2, the labor productivity per FTE in construction has been shrinking. Everybody knows this stat,
FTE?
Per full-time employee.
Okay.
So everybody knows this stat, but it's the implication that matters. That means that if you employ people, every year you're going to get less revenue and less margin on a per head basis, which, coming to the third point, construction, the qualified labor is leaving the industry. In Europe, we're already short 900,000 construction workers in 2024, projected to be short 1.5 million by 2030. In the US, we're short 500,000, projected to be above 1 million in the next few years. In India, we have an overabundance of labor in theory, but it needs to be qualified, right? So that's why we're saying the third point is there's a lack of qualified labor and it's leaving the industry. And now the fourth point, that's the important one. The AECS markets are project businesses, they are services businesses, and they are knowledge businesses. And that makes them what we call a per diem market, meaning construction companies, design companies, architecture companies, engineering companies, their revenue is completely driven through the amount of hours I can bill. And the knowledge that I can have in these hours differentiates me and it defines how much margin I have. But now my productivity on these hours goes down. These hours are leaving the industry while the demand is exploding. So I'm looking at an exploding market that asks me to do more, but I'm doing less efficiently, I have less knowledge. And that's why technology is so important to this sector. That is the most fundamental analysis that you can make.
I'm sold.
You sold? Very good. On the geographies, I think you have very interesting, Asia Pacific, you and Adam, North America or Americas?
Europe and North America, yep.
Yes. So how do you, there's clear leverage from this setup, because you kind of can tap into different markets and compare ideas. How do you manage this process of choosing companies from your portfolio?
Is your question about how we sort of make decisions about companies which may be operating in very different geographies, but how as a team we become smarter and are able to act on all of this information
That's
to
the question.
make investment decisions?
Yes.
So truth be told, over a period of time, we have iterated a great deal on how to improve our processes. One thing to add firstly, which is something we had anticipated, but what we also realized while building Foundamental, the operations or what the processes going into diligencing a firm and picking it vary a fair bit when you've decided structurally to become a global firm rather than if you were, let's say, a country or focus on a specific firm, because your decision making needs to incorporate like a feedback loop and a learning loop. You can't be limited to learning off of your own examples from your specific region. And that's a whole lot of jargon, and you may be wondering.
You have to think of it in a deal discussion that we have every Monday. Whenever Shub, for example, has a firm that he gets excited about, it's the job of the entire team to project ourselves into the local market context, which is very exciting. It accelerates learning so much, but it also demands a lot from the investor to be able to do that, and vice versa.
Yeah, in the beginning, as you would imagine, because each of us has experience and backgrounds in specific markets, there was definitely a learning curve for us as individuals as well as a firm, as a collective, to train that, build up this muscle to be able to pull ourselves out of the geography we are familiar with and to immerse ourselves in the geography of the company that's being discussed. I think it's a muscle we have trained enough as a firm where we are now able to do it, and even when we get younger people into the team, they also have developed like a playbook to do that. But to answer your question specifically, what we have realized is over a period of time, we have realized that there are certain models in which each geography is on a different trajectory, on a different curve in terms of, are they leading in certain models? Are they lagging in certain models? Are they creating what we call category creators at Foundamental? Or are they creating models that become, or firms that become role models in the future? So just to give you an example, so I would say we as a firm are one of the early movers in backing, what we call managed marketplaces in construction. And a lot of them happen to come from India. And so therefore, when we see these kinds of models in other parts of the world, we even come across many generic VCs from that region who, for example, have no idea how to price these companies or value these companies or get excited about certain metrics. But we have actually seen these before. We have actually seen how these firms have been valued at each stage and what tier 1 performance looks like. And therefore, we would generally, over a period of time, have figured out, okay, you know what, you need to ask these questions and this is how you judge companies.
And on that example, right, Martin, to your question, so how our process has changed to leverage the global perspective is, I would say, Shub, in the first year or two, our discussion was oftentimes around the asset. Right? So what is the company doing? What is the founder team like, etc. Run-of-the-mill things that you would do as a VC. Because we are vertical and because we are global, if you were to hop in today into one of our deal meetings, in, for example, the context of a marketplace, in, let's say, a non-Asian geography, our discussion would revolve a lot around the market conditions. And the asset is still something that we need to tick a lot of boxes in and love it. But if the market conditions are not right, because we know what they look like in a successful B2B marketplace, we won't do it. But if you don't have the global view, you will never discuss the market conditions because you actually cannot compare how the market conditions differ across the globe.
Then you kind of wait for the right market conditions to come, or?
Well, I mean, taking market bets is not something that we usually feel very comfortable with, right? So, I mean, market bets are the kind of bets that for us we try to avoid because they tend to be very uncontrollable. So the best way to think of it, like how we think about deals, is there's controllable things and there's uncontrollable things. All the controllable things, you're looking for the right founder, for the right team. You're looking for technology that can solve that. All of that is controllable because it's in our execution. The uncontrollable part, regulation, is the market really going to happen like that? If you're not on a mega shift yet, keep that in mind. You're taking the assumption that the market will inflect, right? And so other things that are uncontrollable. So these are assumptions and bets that we don't like to take because they are uncontrollable.
Is there a specific reason why you chose global? Why not just stick to one geography?
So for me, the main reason was that I don't believe that in any single geography you will be able to identify and drive enough companies that will create absolutely generational DPI, distributions to paid-in capital. The ability to be in multiple regions and the regions operating on different what we call S-curves, so basically different economic cycles at a different point in time, will allow you much better access to liquidity. Like we referenced earlier, you can raise a fund to raise a fund, or you can raise a fund to deliver DPI. And so we're in the second camp, right? And so being in different global markets, in different S-curves, and having access to different company profiles with different IPO liquidity allows you to much better drive DPI than if you're in a single geography.
Look, I think it also comes down to remembering that we ourselves are a startup and we are a firm ourselves. If we judge our prospective investment targets on the basis of whether they're defensible or have a moat, it's only befitting that we ask that question of ourselves, right? Do we have a moat? Do we have a source of defensibility? And in my mind, look, we can obviously create, yet another VC firm, but what additional initiative or investment or additional element or dimension we could add to the firm, which becomes, if we do it right, becomes a source of moat and defensibility. That's, at least to me, it's a very compelling moat.
And
in fact,
to pull that off, you have to be truly global, right? Let me just briefly jump in there, because you will have global in name only. I don't know, how do we acronym that? GINO, right? GINO. So global global in name only is like, hey, I have most of my partners and the investment committees sitting at the West Coast.
Yeah.
And then I will do some deals in Europe and some in India. And that's quite common,
I must clarify, quite often when we speak with folks, they often make the assumption that when we say global, there's probably like a clear slant towards North America and Europe, and we have a smattering. Just to clarify, even for our discussion, it's pretty much like 1/3 distributed across the 3 major geographies, pretty much.
On
right?
the first checks, yeah.
On the first checks, exactly. And I think what needs to be emphasized is if you invest towards that sort of approach, it needs a certain mindset, it needs a certain way of working, and of course it needs people who are embedded in those ecosystems and who are not sort of what I often refer to as tourist investors, right? You kind of keep going in and out of investing in certain geographies depending on what is the flavor of the season or how active the markets are, etc. That needs investing, in certain kinds of processes and building up certain capabilities. It demands doing certain things right, but I think that's also a source of moat. And I think the evidence of that moat is the fact to this day we haven't seen another firm who can claim to be global and focused on our sector.
And the construction is very localized, right?
That's right.
In terms of processes, permits, and the techniques as well. In India, we have RC concrete and walls in between the RC structure. UK, Germany, I believe, are cavity walls.
We love bricks.
And bricks as well. So
and bites.
And bites. We also love bites.
Thanks for that.
Very good.
Thanks for that. Yeah, so I just wanted to ask on these early days as well. So I'm sure the things were not super colorful straight away. There must have been some disagreements happening around some strategy, vision, etc. So
your memory is way better than mine.
Yeah. I mean, look, by the way, just I guess as an additional factoid, because we are talking about our origins, as part of even profiling the people coming together. We even like did an analysis of personality types.
Yeah.
Just to let the cat out of the bag. So Patrick and I are at the complete opposite ends
polar
of
opposite.
personality
What
types.
are they?
Right?
What are you? Who are you?
So for our viewers, the MBTI personality types. So I'm an ISFP, and he's an ENTJ.
Yeah.
So literally the complete opposite.
Which means in terms of like.
So I tend to be like the creative, reserved kinds who likes to conceptualize stuff and work on it and exploring my own sense of adventure, but not in like a collaborative setting, in my own sort of unique style. Oh man, and when I say that out loud,
Scientist.
sounds
It's a good wolf in a wolf pack. It's exactly
Gosh.
right.
Scientist type of.
No,
explorer.
scientist is a very different
Okay.
personality within the matrix.
But don't believe a word. I mean, he's anything but reserved. So, no, and so for me, so the ENTJ is like, according to MBTI, I mean, it's not everything is correct, but so it says like you like to talk to people to gain energy, you tend to be very analytical, you tend to be more frameworky than like bottom up finding out things. And in that sense, for example, Shub and I are like very, very complementary. Adam and I, for example, we are 50% alike, 50% not alike, right? So Adam is someone that prefers like deep thinking before engaging in a conversation, for example. And actually, I think, Martin, it's exactly that reason that we never had a real conflict. To this day, the three of us, never real conflict. There's like on deals, okay, we're bickering. So, I mean, some people actually, when they join us, younger colleagues, like the first deal meeting can be quite scarring when we go at it, but it happens on the content level. When it comes to your question, right, anything about like mission, objectives, strategy, positioning, never. We've literally agreed fairly quickly after intense debate. And after that, we follow the principle of dissenting and committing at Foundamental, right? So we dissent very, very strongly in order to find an optimal outcome, be it about our own strategy or about deals. But once it's done, we commit. We don't reopen the can of worms unless something changes.
Yeah, so that's the maturity, right? Really, I think. And do you have a process, like a very structured process that you approach when thinking about some strategy or deals, or you are more collaboratively coming to the conclusion as three of you?
Look, so I think by design, and this is one of the aspects of being a global firm operating in different geographies, there's a limit to how collaborative you can be at the initial stages of sourcing and thesis forming. In fact, I would argue if you do that, you're doomed as a global firm. It'll be terrible because I think then I think we'll fall into the fallacy of what I said earlier. Each of us will probably gravitate to minimize effort and to maximize consensus forming behavior. We'll gravitate towards what is easiest to sell. So I think what we have, I would say it's a mix of a certain strategic template with, as Patrick mentioned, what we think of, and maybe this is a theme we should touch upon. Each of us are very different personalities and with different strengths. I mean, although we would like to believe we're all somewhat competent in things that matter, but I think our superpowers perhaps lean in different directions and in different aspects. So therefore, how we approach our networks, how we approach deals, what aspects of it we choose to emphasize may be different. And how we eventually win deals, how we interact, also slightly different. So the idea very much is each person has their signature style to it. And we sort of act almost like a counsel in the sense, let's say I really love an opportunity. And the way we approach an investment committee is not so much, hey, me trying to get validation from Adam and Patrick, but they are sort of like my counselors trying to see if there may be other ways in which I could look at the opportunity, if there may be things I might have overlooked, and basically to help me make a better decision. And I think generally the way we approach it, except for a few glaring examples, let's say when there's a diametrically opposite viewpoint, the general viewpoint is if we have had like a fulfilling discussion where we have helped the lead partner of the deal thoroughly see a 360-degree perspective, get everyone's view in, and still feel good about the opportunity. And we also generally, based on the discussion, feel like, okay, we're kind of broadly in the same boat. That's the sort of opportunity we like to do. Of course, the best case is everyone feels tremendously excited. it's a difficult balance to achieve. Usually what we find is, what, we feel pretty good with how we've had this discussion and how we feel, and that we feel you have a comprehensive analysis of the opportunity.
And the process, I struggle with the process part in internal discussions in a VC firm, and here's why. So Shub once gave me a fantastic analogy that to this day I follow. There's companies and industries that operate like a factory. And then there's companies and industries that operate like a craft. And the difference in a factory, I get a consistent outcome repeatedly. The way I go there, of course, is by standardizing my processes and ideally trying to take away any personality and any like quirks or influences in order to harmonize to get to the consistent quality at scale. If you're in a business that is more like a craft, the main difference is you don't want the same outcome every time. You actually treat every outcome as a piece of art of its own. And that's exactly what VC is, which is one of the reasons why we criticize everyone who thinks of VC in terms of let's clone category clones. It will not function because actually the definition of us chasing power law outcomes, very big generational companies, is there can only ever be one of them. And the next one that we chase needs to have its own attributes. So I'm carving a chair, and the next one, I actually don't even want to look like the exact same chair. It needs to be a unique kind of chair or a unique kind of table. And in a craft like that, which is exactly what Fundamental is, you nurture personality. You actually want to see what is the strength of my partner, what is the strength of my colleague, and then enable it, knowing that perhaps your strength is in a different place, and that's when you should be heard or when you should be doing something. And that's how we're approaching our processes. We don't try to implement. We have rigid frameworks and methods, but when it comes to the process, let's stop the clock and this is how long we discuss things. That's absolutely not how we're doing it. It's rather Shub approaches me when he needs a very direct analytical opinion on something, and I approach Shub, for example, when I say, hey, I need a market context type empathy on a specific opportunity. And so that's how we leverage our personalities in order to come to a craft outcome, not to a factory outcome.
Just to complete that, so actually I remember that conversation quite vividly. I think, and I don't know if you guys have heard this in conversation, quite often it will be said that VC is not science, it is art, right? And I think quite often it is used as an excuse to either not be accountable for decision making or to really make random decisions, right? To say, oh, you know what,
Creative.
It's totally unpredictable. No one knows the next innovation. No one knows how to read people. So it's art, right? So here you go. Just take this as art.
I'm a genius.
So there's no replicability.
Exactly.
And I think which is why defining it in these narrowly defined buckets of science where you have this very rigid structure, repeatable process, or art to say, oh, it's completely undecipherable, is a terrible way to look at VC, and it's sort of straitjacketing it in a format where it reduces or even eliminates accountability. I like the craft analogy because it allows the freedom for each professional to express themselves in their own unique signature style, but you're responsible for the product you've created.
You need to master the brush swing. You need to master the method, but you're not shooting for the exact same chair or exact same painting.
Yeah.
Nice. So we've covered the early days of Foundamental, how you guys got together, some co-founder dynamics, the geographic focus. It'd be good to end on how you guys as a firm establish your credibility and fundraised yourself. So what were some of the biggest challenges you faced in the early days trying to establish your credibility? Bearing in mind, you mentioned you didn't have a background in construction. So how did that look to the LPs and the people that you were trying to get amongst within the industry?
I'm a firm believer, and it's been my experience, that whenever you start something, and it's hard, you will always be backed by a person that believes in you, not necessarily the strategy or the market. They need to believe in that too, but there's going to be like 1,000 other people who see perhaps, who could write a slide deck with a similar strategy or a market. So in the end, it needs to be about you. And that's also how oftentimes, for example, founders will approach VCs. It's like they try to get an intro and try to get sort of a curation. Why do they do that? Well, because that way someone tells me, hey, I like this person, you should take a look, right? So that's why founders like taking that route too. And I think that's very rooted in how that is. So honestly, for us, it was not very difficult, but it was not very difficult because we didn't try to convince people who didn't know us. We only tried to convince people who already had conviction in us as people. And then if you approach life, business life that way, if you approach founder life that way, all of a sudden things become exponentially easier because you only have to convince people then of the strategy and the market, but not of yourself anymore.
Okay.
We're gonna close it out.
I just have actually one more question. Okay. So the question about you mentioned superpowers, that each of you has superpower.
Yes.
I'm just curious, is it within like vertical within construction? For example, you love design, you love the supply chain logistics, Adam loves robots, for example. Is that the case, or what?
He's attentive.
Yeah. So I would say that is probably not so much a function of the superpowers. It's more of a reflection of the most painful or most in-demand market need of the respective markets we operate in. Although I don't mind that being a superpower, right? Because I think if that is the case, each of our respective superpowers are aligned with the needs of the respective markets we cover. Was that your question, or did you want me to comment a little bit further?
Yeah, I would also say these might be more preferences, but actually the way you phrase it, it's interestingly closely resembled in the team.
Yeah.
Mm-hmm.
But
Okay.
superpowers would be more like, so let me give you an example, right? So
Everyone has some inclination towards, for me, it's a background in design, for example.
Yes.
So I could say my superpower is like looking at design. But yeah, so that's the question really, like how you...
one of the things that we teach our younger colleagues that come in is that we say, hey, don't try to be like me, or don't try to be like that colleague, because that's a natural psychological effect that happens, right? But it's rather, think of, so we use the metaphor of the craft. Another metaphor that we use a lot is the wolf pack, right? So as Foundamental, we hunt as a wolf pack, right? But that consists of every individual wolf needing to find prey, so to speak. Partners that we want to partner with, right? But so to stay in the metaphor.
Does the oldest one go at the back?
Exactly. And so then as a pack, you come and you basically overwhelm the prey, right? And so because the pack has different skills, that's what makes it valuable. If every wolf had the same skill, in the end, it's just power in numbers. But this way, it's superpower in terms of different ways, right? But that requires you as a firm to actually nurture a wolf pack where every wolf brings something different to the table. An example for me, founders resonate with my directness, authenticity, and honesty. I always say truth and transparency breeds trust. If someone doesn't follow that framework, I will not be for them. Luckily, there's very few founders out there because the top tier founders they will absolutely love truth, transparency, and it breeds trust. And for me, it's very easy to communicate on a level with people like that. And I see that actually 99.9% of the population, they have trouble communicating that way, either authentically or at all, right? So that's one of the superpowers that founders enjoy about me. About Shub, it's something else.
I mean, I wish I knew. I'm realizing in the midst of this conversation that when you're put on the spot and asked, hey, what's your superpower? It's one of those things where you're like, oh gosh, now I have to think of what my superpower is. I mean, I think what I really enjoy doing, and which I think I might not be bad at, is seeing patterns as to what companies and trends and models have become and what they could evolve into, and using that to guide what companies should judge themselves on, how they should shape themselves in the future. Is that a superpower? I don't know.
It is, definitely.
I found that to be like a compelling source of discussion, compelling way to evaluate companies, which I found generally the founders I've evaluated also appreciate.
So maybe to close it off.
I was going to say, you mentioned patterns, which brings us nicely on to our next episode, episode 2, which will be with Shub, and we will be introduced to your third partner, Adam. So this will be episode 2, and we'll be talking about the historical patterns within Fundamental's worldview, and perhaps future trends and where we're going.
We started the story from LP believing in you and investing in your fund, right? So, how do you right now? Do you work with many LPs, or do you work with particular type of LP?
So no particular type of LP. We have families, we have financial investors, we have also investors who come from the construction business. So that way we neither discriminating nor enabling any type of LP particularly. For us, Foundamental is a platform that works for LPs who on the one hand side appreciate the financial performance, and on the other hand side appreciate the ability to work with us. And that is important because actually our philosophy is to build concentrated LP bases. So usually in a VC firm, you could see LP bases in the hundreds, right? Which I guess has benefits, but for us, we like to keep things much more simple. We like to keep things in terms of structuring a firm that, especially around factors that don't contribute to DPI, that don't contribute to the core function of your business, keep those simpler. And one of the, actually I would argue, Shub, the thing in VC that drives complexity is not the number of portfolio relationships. It's the number of investor relationships that you have, especially if your ambition is to give everyone a boutique experience to work with you, discuss market trends, discuss macro factors, discuss mega shifts, all of these things. If you want to give a boutique experience, the complexity is driven by the number of investors that you accept into your platform. And so for us, we're building concentrated LP bases. Currently, we're at 10, right? And we can never see ourselves being above 20.
Mm-hmm. And what size of funds do you usually raise, and how many?
So I mean, for us, so far we have always done very well with being in and around the 100 million euro, and we think for the foreseeable future that will probably be our right strategy, right? You can always have then differentiated pocket strategies where, for example, you say, hey, certain winners in my fund or in my existing funds, they deserve a continuity strategy, and for that I'm going to raise another fund. But that is a different type of strategy than a blind pool investing in early stage companies. So for our flagship funds, the early stage strategies, blind pool strategies, being smaller and capping yourself will actually allow us to access much higher DPI. By the way, I would say to anyone who's not investing globally but vertically, whatever you think your correct fund size is, divide it by 3. Because if you're not accessing the different economic S-curves around the globe and the ability to find opportunity in highly liquid exit markets.
So you're saying that it might be too much money actually chasing, not as many startups, perhaps?
So the question isn't so much on whether more money can be put to better use. It's usually that there is usually a agency problem or even a greed problem with more money, in the sense the more you inflate a fund size, especially if you're an early stage fund, you create a perverse incentive to push money down companies earlier than they deserve it, and maybe in greater quantities than they deserve it, because you can, and because it's a funnel to be done with this fund and move on to other funds. But it's again suboptimal for returns. Going back to our original discussion of what is our objective? What is our KPI? Is our KPI to deploy money and have a certain number of portfolio companies, or is it to make a lot of money for our LPs and for ourselves? And if it's the latter, then even statistically, it's been proven that beyond a certain size, where if you can't deploy it effectively, it's actually a better trade-off to limit your fund size.
Now, I do struggle with this statistic. Of course, it's a super highly cited statistic among LPs, etc. Here's my critique to that statistic.
Here's a disagreement.
Mm-hmm.
Here's my critique to that statistic, right? So we're in a power law industry, of course. And like one super strong outcome will change everything. That's why people invest in the venture asset class. That statistic actually is the opposite of power law. It's averaging out people, right? So if you were to do the same analysis, for example, against a power law of funds, you might come to a slightly distorted view, right? So that's why I struggle with the methodology. However, for us, to your question, Martin, we will cap our funds. It's the only way how we can drive high DPI and not get into any deployment pressures that would do all of the wrong things. So will you ever see an early stage strategy of Foundamental that is 140 or 150 million? Right now, I would say I couldn't see it.
So which fund are you at right now? And you invest in early stages, so from seed to A.
Yeah.
What size of checks as well? Can you elaborate on this a little bit?
Go for it.
I mean, our earliest check could be up to 3 million. The median range would be typically anywhere from 500K to 1.5 million. We have done smaller checks than those and larger checks than those, but this would basically cover 80 to 90% of our first checks. The idea would be to keep following on into at least the high-performing companies we like, to the extent that we can, up to about 10 million, give or take, in our winning positions.
And that's quite unique, right? So if your Fund 2, for example, was an 84 million euro fund,
Right now it's free, right? Number 3.
we've now started 3, exactly, which we haven't publicly announced yet, but which we're doing with this, I guess. But out of an 84 million fund, we actually allocate about a little bit more than 50%, up to 60% into follow-ons, which is quite unique for an early stage strategy. Most founders that work with an early stage fund platform will actually see that the first check will be the largest check they ever got. With us, it's actually the opposite. So with us, we like to lead pre-seed rounds and seed rounds. It's our go-to move. We don't like to follow rounds anymore. But that will not stay the largest check if you perform. We actually have multiple winners in our portfolio, Inframarket being one of them, Enter being one of them, Speckle being one of them, Snaptrue being one of them, where the second and third checks by far outsized the first check, not because they were pro rata, but because they were actually super pro rata checks, meaning we bought more ownership than we initially had. And that's something that the very good founders that we work with can really expect from us.
What else should we ask you about?
There's one thing coming on my mind with all the stock of LPs and superpowers. I don't know to what extent we can go through the story. Perhaps best to not go too far in detail, but one of my earliest conversations with one of our early LPs, believe it or not, was about Iron Man and Superman. Yeah. in the context of the strengths of what we bring as a team. A real conversation.
Yeah.
When I heard superpower, my mind went that way too. Maybe I think like an LP.